Bloomberg Audio Studios.
Podcasts, radio, news.
It's the holiday season, and everyone is getting ready to buy stuff. For a lot of people, that means getting gifts and hitting end-of-year sales. But for companies, it means a different sort of shopping spree.
Microsoft saying, look at all this cash we have. We're going to boost our dividends, $60 billion of a buyback.
This has been a year where sweeteners for investors have played a really big role in quarterly earnings, right? Companies have either been looking to the dividend or to the buyback program.
Companies are buying back shares of their own stocks. Amid a challenging economy for individuals and families across the U.S., some of the top-earning companies in the country are flush with cash, and they're using this cash to do something that was once illegal, but is now one of the more popular financial strategies across sectors.
So companies are taking hundreds or even thousands of shares of their stock out of the stock market, and they're doing this by buying them back. In the past few years, publicly traded companies in the U.S. executed hundreds of billions of dollars worth of buybacks. November through December is typically the busiest period for them. And 2024 is on track to be the biggest year for stock buybacks ever.
But David, I've been trying to wrap my head around why this strategy is so popular. The first time I heard about it, it sounded kind of like a weird move.
I mean, fair enough, because companies sold those shares to investors for a reason. They wanted to raise money to run their businesses and grow their businesses. So given that, it is a little jarring at face to see those same companies spending their own money to get those shares out of circulation.
But it all comes down to how this affects the value of those shares.
It does. If there are fewer shares in circulation, that means each share that's out there is more valuable.
More value means happier shareholders.
And often, happier companies.
Okay, but there must be someone who's not winning in this scenario.
There is always a loser. Stock buybacks have a lot of critics within government and among economists, and according to those critics, the losers are essentially everybody else.
Everybody who's not a shareholder in the company or the company itself?
Exactly. I'm David Gura.
And I'm Sarah Holder. This is The Big Take from Bloomberg News. Today on the show, stock buybacks, why companies do them, why shareholders like them, and why regulators want to rein them in. Lu Wang is on the cross-asset desk at Bloomberg News, meaning she covers the ins and outs and ups and downs of the stock market every day. And she's been writing about stock buybacks for more than a decade. I asked her to break down how and why they happen. We started with the how.
A buyback is when a public traded company buying back their own shares on the open markets. They buy back shares from existing shareholders, just as regular investors typically do through a brokerage house.
So just like a regular investor, the company reaches out to a Wall Street firm like Goldman Sachs or Bank of America and asks to execute the trade. The company can ask to buy all the shares they want on a specific day, or they can buy back their shares over time on what they call autopilot.
So, for instance, if a firm wants to buy back 10 million shares, the 10 million share buybacks would be conducted on an interval, for instance, monthly basis. So each month, 1 million buybacks. That's autopilot.
Lu says there are a few reasons why a company might want to buy back its own shares. The first can be explained by everyone's favorite economic concept, supply and demand.
Well, theoretically, Economics 101 says when demand increases, the prices will go up. So buybacks theoretically represent a source of demand that would help prices go up. For instance, if a company's value is stable, if it's a $100 company, just for the sake of a simplification, and if there are 100 shares outside, then each share would be worth $1.
Right.
And if you remove half of it, then it would become $2.
Basically, when a company buys back its own stock, there are fewer shares out in the world. That means everyone's remaining shares are worth a little more, or a lot more. That's obviously good news for those shareholders.
When the prices go up, they become richer. Their holdings are becoming more valuable.
Higher stock prices also look good on company earning reports.
It helps earnings per share or revenue per share, those financial performance metrics.
And higher performance metrics for companies can also mean higher compensation for executives.
Some of the executives' bonuses are tied to either shares performance or earnings per share growth. So by artificially making the stocks more valuable or their earnings per share better than what it looks, their bonuses would benefit from that.
How is this not market manipulation?
That's a very good question because for a long time, before the 1980s, it was strictly restricted for this very notion that it could be seen as stock manipulation, because basically what happened is companies came into the market and bid up their own stocks and potentially inflating their stock prices. But then came President Reagan's administration. They started deregulating everything, and buybacks restrictions was loosened. Since then, you have seen a steady increase in buybacks. At this rate, this year could be a record.
Wow. Why have they accelerated so much over the past few years?
Well, companies are doing well. They are making record profits. And the economy, despite a lot of concerns about the potential of recession, it hasn't happened. And companies are awash with cash. So that kind of helped them to do more buybacks.
When Trump's corporate tax cuts went into effect in 2018, they helped fuel stock buybacks too. Because when companies have more cash, they tend to spend it on buybacks. Goldman Sachs estimates that S&P 500 companies will spend more than $930 billion in cash on buybacks this year, and more than $1 trillion next year. When you see a stock buyback spree from S&P 500 companies, for example, what does it tell you about the stock market at that moment?
Well, I think I would break it out into two scenarios. One is if it's a steady increase, as we just discussed. It usually happens when the economy is doing well, companies' profitability is healthy, and companies just very confident that they'll be able to generate enough cash to maintain the same pace or even faster buyback programs. Another scenario is when the market is under stress. They have a big sell-off and stocks tanked, and companies see value in their own companies. They would swoop in and scoop up their own shares on the cheap. It's usually a sign of confidence that they don't necessarily see this kind of volatility is going to hurt the business. That's a good sign, not to mention that immediately provides a floor for their share prices.
So buybacks, they can be good for shareholders, good for executives and their stock options, good for the markets, and good for companies trying to lock in a better stock price. But these buybacks are not cheap. And critics argue that all the money companies are spending on their own shares could be used on other things instead. Innovation within their own business, expanding their operations, giving raises to their workers.
That's the trade-off a lot of companies need to make. Do you help boost the shareholder values via buybacks, or do you invest longer term by investing in plants, increasing workers' wage or benefits that arguably would benefit the whole society and the economy over the long run?
It's quite a trade-off. Short-term returns for shareholders or long-term benefits for the economy at large. When we come back, the push to tax buybacks at a higher rate, and whether efforts to rein them in will make a dent at all. Companies flush with cash are using stock buybacks to increase value for shareholders and boost their stock prices. Since deregulation made buybacks like these possible, they've become an increasingly popular financial tool, but also a controversial one. So I asked Bloomberg's Lu Wang about more of the downsides. Who exactly does a stock buyback hurt? Who's losing when companies buy back their shares?
If companies don't invest for the long run, the whole society, the economy suffers because there is no prospect of growth. The other argument against buybacks is on this concept of wealth gap. When you provide buybacks to the wealthy people, they benefit a lot, but it actually left behind a lot of the poor people. Just to put this in the perspective, in the bottom half of American households have roughly $0.4 trillion invested in equities. And that's a tiny fraction of the $20 trillion owned by just the top 1%. So there is a big gap between the rich and poor.
And so these stock buybacks could help these wealthier shareholders who are super invested in the stock market. Right. But it might not help the long-term business growth, which could impact more Americans.
Exactly.
So are there any companies that are famous or infamous for using buybacks as a business strategy?
Well, I wouldn't say as a key business strategy, but we do see a lot of technology mega caps. They have tons of cash in their balance sheets. So they do give out a big portion of the money to shareholders. Apple earlier this year announced $110 billion of buybacks.
What was happening that made them do that?
Well, they just have tons of cash there, and they don't necessarily see the benefit of investing, or buying up another company. So whatever research R&D requirement there is enough to be funded. And they're under pressure by shareholders to boost their value, to appease those kind of investors.
There are plenty of economic conditions where buybacks wouldn't be such a savvy move, though. What does it say about the economy when there's a slowdown in stock buybacks?
Very good question. So when the company decides to suspend buybacks, usually it's when they see some troubles ahead. Either a recession is looming or slow down, or they have some business troubles. They would suspend buybacks in order to preserve cash, and that's not a good sign. For instance, during the pandemic, many companies affected by the lockdowns, for instance, airlines, they suspended buybacks in order to preserve their cash. Remember, some of the companies do buybacks on autopilot basis.
Right.
So sometimes they announce the buybacks. For instance, Apple's example, they plan to do this over the next couple of years. And they say, okay, we're going to suspend buying our own shares either on a quarterly or on their monthly basis.
So a company could have said in 2019, we're going to be doing buybacks for a couple of years. Then the pandemic hits, they might have to cool it.
Yes,
on the buybacks.
Exactly.
Stock buybacks are here to stay. But there's been an effort to rein in the frenzy at the federal level. President Joe Biden and Senators Elizabeth Warren and Chuck Schumer have been vocal critics of buybacks. So has President-elect Donald Trump, who in 2018 called out companies for using some of the cash they saved from his tax cuts to fund buybacks.
So Democrats and Republicans have different opinions on a lot of things. But when it comes to buybacks, they seem to be on the same page, which is buyback is not good for the long-term prospect of the economy. And companies should use profits to create new jobs. So in 2022, Congress voted to impose a 1% tax on buybacks.
And what did that tax do?
Well, the goal of that tax is to discourage buybacks, but that has done little. It's too little to make a meaningful difference.
Biden had wanted even higher taxes on buybacks. In his 2023 State of the Union address, he called for a quadrupling of the rate to 4%. But he's leaving office with the 1% tax in place. And with the Fed leaning towards cutting interest rates more and Trump proposing more corporate tax cuts, experts project another banner year for the buyback.
Well, Goldman Sachs has a very optimistic forecast on buybacks. They're projecting 15% of increase from this year, which we know is heading for another record.
Thanks for listening to the Big Take podcast from Bloomberg News. I'm Sarah Holder.
And I'm David Gura. This episode is produced by Julia Press and Alex Segura, who also mixed it. It was fact-checked by Adriana Tapia.
It was edited by Stacey Vanek Smith, Aaron Edwards, and Sid Verma. Naomi Shavin is our senior producer. Nicole Beamsterboer is our executive producer. Sage Bauman is Bloomberg's head of podcasts.
Please follow and review The Big Take wherever you listen to podcasts. It helps new listeners find the show.
We'll be back tomorrow.